I need to start this video with a confession. I recorded this entire video a week or so ago, and then I didn't post it. Not because the deduction isn't real, it is. And not because the math was wrong, it wasn't. I didn't post it because the more I listened back, the more I thought, if a normal person follows this, they're gonna do something dumb. And I don't feel like being responsible for that. My conscience said you cannot tell the average person that the new auto deduction is a good deduction to chase, because right now the internet is obsessed with maxing out the new $10,000 auto interest deduction like it's a video game achievement. And sure, you can do it, but you probably shouldn't. So today, instead of pretending this is some universal tax hack, I want to break it down honestly. Why this strategy sounds amazing, who it actually works for, and why most people should absolutely not be trying to copy it. We cannot let the tax tail wag the dog. The goal is to not light money on fire and call it planning. Now this $10,000 number, it can be a trap. Let's start with the number everyone's excited about, $10,000 auto interest deduction. But it's a cap, it's not a goal, not a challenge, not something you're supposed to unlock. In a normal real-world scenario, $50,000 car, 5-year loan, 7% interest, you're paying about $3,000 in interest in year one. That's it. So when someone online says just max out the deduction, what they're really saying is take on worse debt until the math looks impressive. Well, that's not tax planning, that's just stupid. Now, before strategy even matters, this deduction has a ridiculous numbers of ways to die. Miss one box and you get a zero. The car must be brand new. For personal use, under 14,000 pounds, that one's easy. But final assembly in the United States, this one's going to get a lot of people. And the loan must be for a purchase loan secured in the first lien position. So no, that means no to leases, no to used cars, no to refinances. Especially be careful with the dealer said it qualifies. We need to make sure. And no, an American brand in and of itself does not mean it counts. We got to make sure the assembly rules are met. If your tax plan relies on trusting a salesperson, surprise, surprise, salespeople don't always tell you the truth. Okay, so income limits. This is where that TikTok logic falls apart. The new car deduction is controlled by something called your modified adjusted gross income. And this is where the internet advice completely disconnects from reality. So the phase out starts at $100,000 single and $200,000 married filing joint. And for every $1,000 over the line, you lose $200 of the deduction. Now here's my favorite piece of advice I keep hearing. Well, just keep your income under the limit. Well, duh, why didn't I think of that? Just email payroll and let them know, I'm done earning for this year. That's not how it works. If you're a normal W-2 employee, you don't control when income hits. You don't control when your bonuses land, when you get your raises. And outside of an HSA or retirement contributions, there aren't a lot of levers you can pull. You either qualify or you don't. There's not going to be a lot of strategy here. We just have to accept that our income is what it is. But who does this actually work for? This is where the conversation changes. This strategy makes sense for people who control when their income is recognized. That means it could be good for business owners, not in their business, but personally. For partners, same thing, pass-through entities, people with variable or discretionary compensation, people who live off of their investments. The reason why is these people, they can delay income, accelerate expenses, they can manage their distributions, they can time their retirement contributions intentionally. They can also choose to write off equipment all in 1 year if that helps on their personal income. It also helps those who have the ability to control which bucket or account they're going to take money from. Example, Roth distributions. If you pull money from a Roth, it doesn't affect your MAGI. So for them, lowering MAGI isn't theoretical. It's a lever. And here's the key point. They're not contorting their lives for a car deduction. They're already managing income and the deduction just stacks on top. That's tax strategy. Everyone else trying to copy it is just pretending they're wealthy while continuing to make mistakes that are going to keep them poor. Oh, I hate this one. Loan structuring, where people start paying banks extra on purpose. Now let's talk about loan structure because there is advice on the new car interest deduction and it can get dangerous fast. Yes, auto loans are amortized. Yes, longer terms create more interest up front. And yes, you'll hear people say take a longer loan so you pay more interest and get a bigger deduction, which is an amazing idea if your goal is to donate money to the bank. Paying an extra $5,000 in interest to maybe save $2,000 in taxes is not a win. Well, once again, that is just stupid. If your tax strategy requires you to lose money first, you probably don't have a strategy. You probably have a problem with rationalization for buying something you really can't afford. This only works if you were already buying the car. The payment is comfortable. The loan terms make sense without the deduction, and the tax benefit is a bonus, not the reason. Let's be honest, this deduction is only $10,000. If you're in a 24% bracket, that's $2,400. This is not worth making bad decisions. What about this one? There's the just buy two cars crowd that we're seeing out there, and this is another idea to use the car interest deduction that's driving me crazy. Because yes, technically the $10,000 limit is per return, not per vehicle. So interest for multiple qualifying cars can stack. But when somebody says just buy two cars, what they're really saying is, let me help you blow your money. You have to wonder if they work for a car dealership. This only makes sense if both cars were already needed, both were already going to be purchased, your income supports it easily, and you're under the income limits. Now think about this. It takes about $150,000 at 7% to get to a $10,000 of interest. Should the average person be buying $145,000 of cars on less than $200,000 in income? If you're buying extra vehicles just to chase a deduction, congratulations, you're going broke. This deduction rewards people who already have their act together, and it punishes everyone else who chases it and tries to act like they are rich. Now, some things that do matter if this works: we need to keep our purchase agreement, our window sticker, VIN proof, loan docs, year-end interest statements, because trust me, bro, the salesman said it will work. I promise, not an IRS-approved filing position. So my final thoughts, here's the real takeaway. The auto interest deduction is not a goal. It's not something to chase, and it's definitely not a reason to buy a car you wouldn't otherwise buy. Good tax planning supports smart financial decisions. It doesn't require worse debt, and it doesn't come from social media soundbites. I know this is social media, but trust me, if a strategy only works when everything goes perfectly and income has been planned, it's probably not for normal people. That doesn't mean you can't use it. All I'm trying to say is don't try to maximize it. It's not meant to do that. If this kind of honest breakdown is helpful, hit subscribe. I'll keep translating the tax code, and from time to time, I may even mock bad advice like this so you don't have to learn the hard way.